Good afternoon or good morning, depending what continent you're on. Welcome to our conversation, Risk and Performance No Longer Compromised. We've scheduled this as a 30-minute session to make maximum use of the time. We call this a conversation as we've also decided to eliminate death by PowerPoint, which hopefully something you'll be grateful for, and obviously make best use of this 30 minutes. There will be some time at the end, so please submit any questions as we go. You have a panel on your screen which allows you to submit questions. Please go through. We'll try and deal with those at the end. Once we don't have time to cover, we'll follow up by email. There is also a polling service on this webcast, so there'll be 3 questions as we go through, which I'd ask you to think about and respond to. You'll have about 20 seconds for each of those. We focus this session on the paradox that exists between risk management and financial performance management. These 2 processes tend to be seen as conflicting, certainly in terms of effort and cost, and I'm sure many of you identify with that, hence the healthy attendance at this session. We know performance is measured every day, every month, every quarter in our businesses. It's very clear, it's rewarded and punished with regularity, it has very obvious outcomes. Risk management and control, on the other hand, is slightly more difficult for general management to grasp as a concrete concept. Risks only really become tangible when things go wrong, and hopefully that's not a daily occurrence. It may be controlled or ticked off regularly, but sometimes it can be regarded as a theoretical abstract process. We have observed that effective and appropriate levels of risk management and managed performance are both characteristics of a world-class finance organization. And that's the essence of our discussion today, sharing experiences, observations, best practices. My name's Dan French. I'm CEO of Consider Solutions, where we focus on risk management and performance issues for the finance function. I'm joined by Juergen Mueller.
And I'm a partner at PwC, and my business is providing assurance around risks. And Dan and I, we met maybe 4 years ago, first time, and our discussion was mostly about risks and assurance and control since then. Intellectually very inspiring. And we both shared with each other that I'm afraid to come across too much as a German, while Dan said, I'm afraid that I come across too much as an English. But as we both know each other now very well, you will see today that there is a strong line that wherever we're coming from is keeping us together. Now Dan, you spoke already about the characteristics and the importance of world-class finance functions. What are they?
Well, Juergen, we both know some organizations in this class. I know that you'd agree when I say that a number of characteristics, some are quantitative and some qualitative. One of the key benchmarks that is constantly adhered to is this issue about how you measure the cost of finance relative to revenue. And generally regarded that those of a world-class finance capability, the cost of operating their finance function is approaching 0.5% of revenue, which compares to 1 or 2 or even 3% at some other organizations. Now, clearly, that's not the only measure, but it's a key part of showing both efficiency and effectiveness. And how they achieve those, that interesting operating level is an interesting study in itself. But they operate with a low cost of finance because they simplify and standardize. But they still have to deliver key services of the finance function. They've got to deliver stewardship and financial reporting. They've got to deliver all of the operations of accounting and finance consolidation, and they've got to deliver effective business and management support to the operations. But those businesses also all tend to have common continuous improvement strategies. Certainly first one you would expect was that comment about cost of operation, efficiency. Obviously a continued drive to improve process efficiency, speed and quality, which is part of the focus of driving down that cost of finance. But the other part of it is effectiveness, which is about doing the right things, and which is all about delivering the expertise in financial stewardship for the organization and risk management, which is a key part of today's discussion. The other 2 are perhaps less obvious. Relevance, which is providing analytical support that decision makers need across the business, using the finance tools to help business operations, and influence being a real business partnership to proactively support the business and drive towards superior outcomes. And those kind of the 4 strategies. And it dawned on me that there's an interesting echo here of the work of W. Edwards Deming some 50 years ago, which shows my age, if not anybody else's. He was the father of total quality management. Many of you will remember. He was adopted by the Japanese after being virtually kicked out of the US as a lone voice in the wilderness. And he was almost single-handedly responsible for turning the Japanese auto industry in the 60s and 70s to world leadership. He argued, against all the received wisdom at the time, that quality and efficiency are naturally in harmony if you take the right approach. And the interesting question for us is it possible that the same is true for risk management and business efficiency? So, Juergen, can you explain this issue of the compromise between risk management, control, and compliance, and those factors driving business performance, and why they seem so polarized today more than ever?
I think our vision is that what they mean that for the motor and auto industry is true for risks, controls, and performance. Because what I have observed, and I know you agree, is that with the Sarbanes-Oxley, there came a lot of need for formal documentation and assessment of these controls. There was a split in the organizations. And there is a split in the organizations that was before not happened, because internal controls have been an integral part of many businesses, especially in the Anglo-Saxon hemisphere, for many, many years already before. But Sarbanes-Oxley brought the split. There is today, I see the business focusing on achieving set objectives, and their internal controls expert focuses on bringing the best practice controls in the organizations. And as there are a lot of good and intelligent people organized and then hired in this organization, we creating a lot of controls and risks which stand somewhere beside the business and beside the objectives that we are running for. So companies ending up with two sets of controls, two sets of argumentations, where often the formal controls group has the final say of what are the documented official controls. And these controls groups are sitting normally in the finance organizations, because it's the CFO which is mostly targeted by all the different laws and regulations that were coming in. So that's the one thing, that there's clearly the business and the controls groups competing. And then I see a second thing. The more we have headquarters in large organizations, and these headquarters are sitting normally somewhere in the United States or in Europe, if these headquarter teams try to make approaches which are true then for the rest of the world, reality hits them when they come from the well-developed countries, the mature markets, where you have a certain setup. When you then come into other markets where you are a new player, where you want to gain market share, you need to have other types of controls as if you are somewhere in a settled business. So I see these are two main drivers which leading to the discussion that we are having today.
That's an interesting point, Juergen. I'm thinking back to that Deming reference. I remember companies in the 80s, particularly, there was, even the beginning of the 90s, it was regarded as quality was too expensive. You couldn't afford to do quality, but you couldn't afford to do things right, but you could afford to do things again. I remember that comment. There's an interesting perspective. It seems over the past 10 years, obviously since stocks and everything that followed it, we have become preoccupied with control itself as a result of heavy focus on compliance. And the compliance mandate has obviously been a catalyst for organizations to understand their processes better, which is a great thing. But compliance has often developed a life of its own. And we've got to remember that controls are purely man-made concepts designed to help us manage risk. If you like, they're the how to the what of risk. And many of the controls we've designed are resource intensive. They sit outside the processes we're trying to manage risk in. They add extra work, and they become almost an end in themselves rather than a means to end of better risk management. So that is definitely one of the observations. And we see organizations spending an enormous amount of time, even now, even after trying to do consolidation and rationalization of controls, still spending a lot of time documenting controls, testing them, reviewing them, reporting on them, which isn't really a high-value activity when you think about it. And people performing the controls and the controls review often become, to a certain extent, tired and, in the worst scenarios, demotivated from this activity because it doesn't seem to relate to them to the direct operational targets of the business. So we need to return to some understanding, a more balanced understanding, about the real risks for our business as a whole in the context of the performance you want to drive, because the risks are impacted by what performance you want to drive. And we need to consider it both globally and by different levels of maturity of our markets across the organization, which I think is a great point, Juergen, you make. Organizational maturity, market maturity, even in one organization, drives us to possibly different ideas of what the risk and control priorities should be. But I remember talking to you, Juergen, some weeks ago about it was kind of interesting that over the past 10 years, sometimes we have put the best and brightest in our organizations into risk and control. What's your take on that?
I definitely believe that there is a big risk. If you hire very bright people in the risk and controls group, there is a risk that the organization drives apart even further, because smart people will find with their brain new risks and then attach new controls, because this is what you hiring them before. Mm-hmm. So this comes in all, it needs to come together. While these people are important, and it is important to talk about risk and controls, it should only be attached to the objectives in which you want to drive your company, but not in the moment when you stand them beside, they will come up with a hell lot of new risks and new controls, and we said it's not value add. It's not driving the company to where we want them to be.
That's an interesting perspective. So no offense to any MBAs in risk management or financial control.
No.
We have now our first poll question, which I would like you to just look at and think about. I'm going to give you 20 seconds for this, and it should be fairly straightforward. But to what extent do you believe there's a conflict between efforts in risk management and financial control and operational performance in your business? And you see the 4 options there. One of the options is I don't know, which is fine up to a point, I guess. So have a think about that, and please give it a response. We will be sharing the results of this. So there's only 4 choices. So I'm assuming you've worked out which one you're going for. Great. So Juergen, we've talked a lot about the analogy between these topics of risk and performance and the human body, the cardiovascular system that drives blood and oxygen around to our muscles and key organs, and how it helps inform our thinking about business processes. Can you explain that in a little bit more detail?
Yeah, of course. You know, and now I need to switch from an English doctor's room and a German doctor room to a Switzerland doctor room.
In an English doctor's room, you won't get much help.
Yeah.
These days. The Swiss doctors are much better, so this is what I'm using their example.
So if you come into a doctor's practice in Switzerland, the first thing, even before you have said hello and who you are, somebody comes, sits you beside, and takes your blood. And then you will see the doctor and talk what it's all about. The doctor will interview you and make physical and verbal exercises, while then the blood sample is used to support the doctor's physical tests. And while, again, the physical tests and the verbal tests of the doctor are often very theoretical. He will say, how do you feel when I touch this? And how was your digestion? And how do you feel these days? It's very theoretical. The blood can be used to substitute what he is doing in his exercise. But the blood can, on top of that, also indicate where maybe indicators show that something is on the horizon coming up, so if there's not enough iron in the blood or whatever. And this is, in my opinion, a very good analogy to the ERP systems and the finance systems that we have, because in the control space, we often talk about the configuration settings, the workflow controls, and the segregation of duties. And again, in many cases, that remains very theoretical, because even the theoretical assessment can be good. For example, you have only 5 segregation of duties issues, or very bad, you might have 500 and everybody is extremely concerned. When you have not taken a blood test, you do not know where you stand, whether the 5 is indicating something or the 500. And maybe the 5 have led to worse things happen to the transaction, to the quality of the transaction than the 500. So to be doing very well on the theoretical risks. In reality, business activities may look very different. And here's something important. I don't say that this discussions that we had about configuration setting and SODs and workflows isn't important. But as long as you only talk on this level, you remain theoretical. You remain extremely theoretical. And if you don't support it up by looking into the transactions, you will always be, you don't come to the ground. You don't know what's going on.
Well, that's a very good point. It's almost counterintuitive, isn't it? So, you know, the issues of you find control issues, maybe 5 or 500 or 0, but whatever number it is, it shouldn't necessarily give you any different level of confidence about your business. That maybe even with one control issue, you might have a much bigger impact than 500, which I find very interesting, and it's probably not the way most organizations see it today. But Juergen, this idea of a blood test for a process is an analysis, not of controls, but the transactions running through the business, right? So inspecting them for deviations or exceptions to risk tolerance or to what's needed for performance. Is that right?
That is right. And let's go into a little bit more concrete stuff, because I think the people don't want to learn about blood tests, but what it means in the business setup. So you know, a lot of the clients that I'm meeting, they say, you know what, we are perfectly in control, three-way match, and everything, what is a three-way match, is going through our system, is perfectly controlled. When you dig into the details, what do you observe typically the transactions that are created through the three-way match?
That's a very that's a good point. I think there's been a lot of focus in recent years about this idea of preventive controls, which are those things that it's supposed to stop bad things happening, such as the three-way match embedded in your finance or ERP system. But there's growing evidence that some of these preventive controls give us a false sense of security. I mean, so for example, this three-way match between the purchase order, the goods receipt, and the invoice. You know, the idea that if you ensure you have all three, you're going to end up with a good result. I mean, a couple of interesting points. At a control setting level, we've spoken to a number of organizations, certainly one particularly I'm thinking of, who absolutely convinced had a very, very good control setup. Yes, we have the three-way match set for across our business, and when we did the controls analysis, it was set, but only for 20% of the vendors, which was a bit of a surprise to the organization. But the interesting piece is you've got to think about the risk. Companies want to ensure that they're paying for what they've authorized, paying for what they've ordered, and paying for what they've received. And the risk is you don't want to be spending money on things you didn't mean to or you didn't get. So it's all very well to say, even if it's good to test the controls, it's good to test you have a three-way match, and we certainly recommend that and help clients with that. But when looking at accepting transactions, even if you've got a perfect three-way match set up, we see invoices being paid at higher values than what had been delivered, sometimes higher values even than ordered. Sometimes people have automatic payment tolerances, and you have suppliers who are manipulating, or certain suppliers manipulating to make sure they hit just within the 5% tolerance so they get a bit more cash out. We've also seen often that purchase orders and goods receipts happen on the same day, which typically indicates purchase orders are only created after the event just to enable someone to post the receipt or the invoice. And we've even seen examples where the delivery note determines what price will be entered in the system and what will be paid. So it's very important not to get a full sense of security. Even if you're confident in your controls, think about the risk. There's a broader set of issues.
And it is definitely true that users of systems find their way to work around the systems, maybe also to walk around, but to work around. And the three-way match can be configured perfectly, and there can be a workflow and still be finding these transactions. What else can we discover by looking into transactional blood of the company?
Well, we've talked a little bit about risk, and just trying to move the picture here. Yes, we talked a little bit about risk. We've got to think also about performance, because this is about the risk and performance paradox. So when looking at the purchase to pay, accounts payable cycle for both risk and performance themes, one of the key performance indicators of the payable cycle is total cost per invoice, which is essentially the total cost of the accounts payable and purchasing function divided by the number of invoices you have, which is a good way of giving you a benchmark to compare against other organizations. Now, we've assisted a company to identify barriers to reaching their targets for total cost per invoice, and one of the things we're looking for is things that would add effort. So we found, in one case, 9% of indirect purchase orders were going through a multi-touch process, with prices and terms being changed after creation. Now, a controls viewpoint, or even a risk viewpoint, would say, well, so long as those prices and term changes were okay within accepted tolerances, we're happy. But if you think about the performance here, with nearly 10% of activity going through multiple touches, and what we found is once a purchase order had one or second touch, it usually got several others because that created ambiguity, error, and waste and all the rest of it. You know, it generates further effort downstream with no real business value. And we did it by automatically analyzing every transaction in the system, or to use your analogy, Juergen, every liter or pint of blood in the bloodstream. And then that helped them drive down the cost and effort of the process, and it's an example of performance improvement.
And let me build on that, because you maybe have heard it now, but risk and performance are two sides of the same coin. If you, for example, consider cash flow and the days of sales outstanding as a key performance measure, from a risk perspective, the key risk is not getting paid, hence the evolution of controls for credit checks and payment terms, delivery controls, and so on. But performance is impacted by error and waste, as well as the risk exposure and the control failure in the very last moment. We find that late changes to the payment terms can have an impact on the DSO, much more. And it's much better to find these exceptions early and fix it, instead of monitoring that the DSO goes down and down and down and goes into a red areas. And
so that's a great point. We've now got the second poll question for you, which is the finance function monitoring business exceptions at a transactional level to help drive improvement in core processes? So just have a think about that in the context of what Juergen's been saying and some of my comments. Again, 20 seconds to mull that over. You've got 5 options. So you've got 4 seconds on each option. So I'll just give you half a minute for that. So,
we talked about it. We know that being more risk consciousness rather than control focused is part of the answer. What else would you recommend companies to do to get more effective in risk management and process performance improvement?
Right, Juergen, from what we've seen, I think there are 2 key strategies. And I don't want to oversimplify because it's always dangerous to do that, but here's the 2 key themes that I think are critical. One is risk and performance can be in harmony and avoid compromise if they're both part of the same conversation with the same business leaders and the same process owners. The discussion should be early on what can go wrong here in this process and what will stop us achieving our objectives. That's both a risk and a performance impact discussion. Do that early and you solve a lot of problems and cut down a lot of pain later in the day. And I agree, a lot of people may think, well, we've been through this process, but actually most organizations have been through 2 distinctly different processes. By bringing this together, even in one process area, you'll see the difference. Second key strategy is about managing the business and not managing the controls. The old adage is very true. You don't get what you expect, you get what you inspect. And if you monitor the business transactions, and not just the controls, you start to see what's really going on. And you can see where exceptions are occurring. So testing the blood tells you a lot more, for example, than checking for lumps and bumps in the doctor's room. We're talking about exception analysis for finance processes. These exceptions can be risks exposed or things that get in the way of simplification and efficiency. If we do that, we cut the cost of control as well. So, Juergen, how do we get an assessment of our process risk and potential performance inhibitors?
You know then that my email address is juergen.t.mueller, and the T definitely doesn't stand for theory. So if we go today in existing companies, I think we take the processes, their key risks, and their performance impacts, and we just take them as they stand. No theoretical discussions, but we are going and we analyze over a period all transactions and take snapshots of the data, of the exceptions by theme and by process. And that we map back to the theoretical area. Some of this data we will be using in details, and some others we are using aggregated, because what we also said before, we need it by region, by units, so that the exceptions make sense. This is what I would think is important to do going a step forward.
Right, so with this data, process owners and business management have their fingers on blood test results. You can diagnose root causes, take action, drive the business forward in a process of continuous improvement. I guess it's like gears on a bike. The more we get through the bumps, the higher gear we can use to maximize speed and efficiency. It's a fascinating conversation, Juergen. There is now, I'd just like to ask you the third poll question, which is, in which financial process area do you see the biggest benefit of monitoring business exceptions in the way we've been discussing? Just have a think through that. Do appreciate your input on these. I think it's going to be helpful for everybody to share the high-level statistics. It's going to be anonymized individually, so don't worry about that. I think if you've got 3 I don't knows, you might have bigger questions, but the odd I don't know isn't a problem.
That was a very English joke, wasn't it?
I'm afraid so. We'll do the German joke later. So,
I'm afraid there aren't one.
So we'd like to come down. We've got to appreciate the questions you've been asking. Got a couple of questions from the audience. You can keep asking them now if you still have got questions. So the first question here is an interesting one, and given the what is the role of internal audit in this new approach you envisage? So it's a very good question, very on point. So my first assessment, I'll ask Juergen for his views, but clearly internal audit has to remain the independent management assurance vehicle, so that doesn't change. I guess there's a question about whether or not we want internal audit to be more consultative with the business and offer both risk assurance as well as help them with performance gaps.
Internal audit would be a webcast in its own.
Exactly.
And I would do a statement here. I see internal audit departments are pushed too much around, and it's like in circles. You know, sometimes they want to be partners, then they have more an approach to be very independent and come in and be the length arm of business. And then a lot of people say, you know, internal audit is a platform for our business people. So you see some internal audit departments who at a certain moment don't have any internal auditors anymore and have only business people who try to run the business that maybe auditing business functions that they have auditing before. But coming back to the initial questions, what's the role of internal audit? I think internal audit needs to do the same thing that we spoke today about.
Yeah.
They need to understand in which direction goes the business and how business is running it. And I think it would be a very bad indicator if you come to a businessman and he just pulls out his 10 pages of internal controls,
yeah,
where he makes his tick mark at the 30th or the 31st, and then he runs his business very differently from the internal controls. So that would be an indicator for an internal audit, where he says, look, guy, you need to bring together how you run your business and how you approach the risks and the controls.
It also comes back to the earlier comment you made that, you know, if you do a controls, you know, an audit of controls, then basically you might find 5 issues or 500 issues, but if you can provide some kind of blood test, transactional analysis, you can give a real assessment of what does this mean to the business rather than just in abstract. Another question, I think we've got time for one more question. You mentioned the assessment, blood test. If I do annual control self-assessments, what's the value of this? Well, I mean,
somebody wants to say, I do annual, quarterly assessments. What's the value of this?
What's the value of the assessment that we just described?
Yeah, I think if you do only self-assessments or whatever kind of assessments of control, you remain theoretical. The thing that we are adding in here is, while it is to a certain extent important to have a look through your controls and your risk framework, get to the transactions. That's where the add-on comes. We give a real picture of what's going on.
So it's an incremental process, not instead of. So I think control self-assessment obviously addresses controls, doesn't address performance topics. It doesn't necessarily address the effectiveness of the controls in managing the risk. but I think you see this as being a corresponding balance. And certainly we see the point of testing and assessing controls is a key point, but in isolation isn't enough. I think we have hit our 30-minute time, so I would just like to thank you all for spending 30 minutes of your day with us. Hopefully this briefer format is helpful to you, hopefully stimulate some ideas. There's a few thoughts on the blog there. Again, similar kind of thoughts as this, kind of about the issues of risk and performance balance. Any final comments, Juergen?
Only that we plan to have another webcast in 2013.
Yes.
And then a very special webcast maybe in springtime 2014, especially around Germans and Englishmen and the ball in the middle.
Right. Yeah, for those of you outside North America, this is the Football World Cup Juergen's referring to. For those of you in North America, it's the Soccer World Cup. So we have to, in that year, Juergen and I will not be performing these kinds of discussions. We'll be deep adversaries. Thank you very much for your time. Do appreciate it. I hope you found it useful, and thank you.